Welcome back, everyone. For our roundtable this week, we want to give you the clearest picture we can about what to expect from the Fed's big announcement next month and tell you exactly how to position yourself to anticipate it. And to help us do that, Mike Larson is back with us. He is an interest rate and financial specialist at Weiss Research and, of course, the editor of the Safe Money Report. And joining him on set is investment advisor Steve Chapman. He's the vice president of Weiss Capital Management. So good to see both of you here. Thank you, sirs, for joining us.
Thank you, Jamie.
Mike, you were in the show a little earlier, obviously giving your expectations on what we can see from the Federal Reserve. Get a little more specific here for me on how you think they're going to ease their monetary policy.
Sure. I think what we're going to see in early November is an announcement of maybe $500 billion, $600, $700 billion, kind of an outside chance of quantitative easing or money printing. And I think they're going to use that money to buy assets, predominantly treasuries, as opposed to last time where it was more focused on the mortgage side of the ledger. And I think they're going to leave themselves the wiggle room to sort of ramp that up or ramp it down depending on the state of the economy. If things get worse, they spend more. If things get better, they spend less.
All right. Sequels are rarely better in Hollywood. What do you expect for us when it comes to QE2?
Good part, Jamie. I think, as Bernanke said last week, we're going to calibrate and communicate, which is a continuation of what Mike said. They're not going to let all out of the bag, but they're going to continue a slow process of this. They're going to ramp it up as long as they need to until they think this actually stimulates whatever they want to stimulate. But what they really need to stimulate is Main Street. And Main Street didn't get money the first go-around, and I don't think they're going to get it this go-around either. So, you know, you're putting all the wrong medicine in the wrong spot. But it has implications for investors, and I think these implications could be used to one's benefit. But you just got to know that you're on a ground that's being created and not fundamentally sound. And on that basis, if you want to proceed, just keep your eye on the ball.
All right, so Main Street's not going to benefit, but the market very well may. Let's go through some of the different asset markets. Mike, tell me what you think. Where will the hits be on this list?
Sure. Well, if you go down the list of different asset classes, maybe start with commodities. I think that commodities and especially gold are going to benefit. Gold is almost like an alternate world currency at this point. The Fed is trying to debase the dollar. The Bank of Japan is trying to debase the yen. The Bank of England is trying to debase the pound. So there's sort of one currency that's left that holds its value when all else fails, and that's gold. When you look at that, again, commodities, gold, probably very good long-term investments. I think in the stock market, when the QE2 program, the talk of this started filtering into the market, you had all stocks essentially rising in tandem. What I think is going to happen now, and you're starting to see, is more earnings-specific, stock-specific news starting to hit various companies out there. So you have to make sure what you own is the good stocks, not the lousy ones. And as far as bonds are concerned, I think what you'll see is short-term rates continue to be low and maybe even head lower, but long-term interest rates, such as those in the 30-year bond, could be problematic. I mean, all this inflation the Fed's trying to create is ultimately bad for fixed income, for long-term securities like 30-year bonds. So you'll probably see prices come down and interest rates rise.
Steve, your predictions for these markets?
A lot along the same line as Mike. I think, the dollar-denominated assets, oil to add on to Mike's list, gold miners, that type of thing, where you get leverage of the gold and still participate in the stock market is going to be good. I think the money flow overseas, the emerging markets, younger economies, better currencies, beginning to decouple a wee bit from the U.S. dependence.
That's a great point about the emerging markets too, Jamie. The Fed and the Bank of England and so on are trying to target domestic economies, their domestic economies with all this money printing, but that money's leaking overseas. You're seeing it head into economies, currencies, stock markets that are performing much better, that have much better growth prospects. So I think that that's ultimately bad for the dollar, but good for some of the emerging markets like Singapore, Malaysia, and so on that are absorbing that money.
Let's talk long term now. Whether you agree that QE2 is going to work or not, where can investors actually put their money that's going to benefit them broader terms over the next couple of years? Steve?
Yeah, I'd say let me say it this way, for as long as the QE continues, these themes should be present. If they stop it, or the stimulus changes, or they slow down, or specifically if the dollar picks up, because the dollar is so much the key to this whole mindset of money flow. So if the dollar begins to pick up, and nobody, like the old guy said one day, the reports of my death are greatly exaggerated. I don't think the dollar is dead in the water yet. So, but for the time being, it's not the trade to be in. But watch it continue to proceed. I would look at large multinational companies here domesticated in the U.S. but has a good overseas presence, number one. I would add on emerging market bonds to pick up the higher interest rates in addition to some of the domestic positions. A good company would be, for example, Yum Brands. that gets a lot of money from overseas, that whole KFC, that whole thing from China, that would be something good to consider.
Again, the multinational companies, for each yen or pound or euro that they earn overseas, it translates back to more dollars as a result of the falling dollar. So it's good for profits and bottom line.
Right. But if everything is hinged on the dollar now, just to, if you want to go out there, that's fine. But just pay attention to the dollar, because when that starts to turn, and it will, eventually all these other countries, it's still, after all, the world's reserve currency. I mean, it's not like we're one little country that can just trash its own dollar. We are still the reserve currency, like it or not, for better or worse. And there's going to be a point where, the byproduct of QE is going to debase our currency and inflate others. And these other countries are going to say, well, that's it. Brazil was in last week buying dollars. China was buying dollars. So you never know. It's a good trade. I think it could be fragile, and it's going to depend really on the outcome of the dollar.
You really have to keep your eyes on the exits here, take profits along the way, because
Absolutely.
again, when you do get a correction, I think it's going to be ugly.
All right, gentlemen, thank you so much for joining us.
Terrific.
Steve Chapman, Mike Larson. Also, thanks to Jen Amos, Brian Rich, and Tony Sagami. And of course, as always, if you have questions for any of this week's guests or suggestions for topics that you'd like us to cover, just email us here at Weiss Money Network at weissinc.com. Coming up next week on Money and Markets, currency wars. As we've heard today, countries all over the world are devaluing their currencies. We'll find out who's winning the battle and what it means for you. I'm Jamie Holmes, and now, Martin Weiss.
Thank you, Jamie. This whole quantitative easing story is crazy. But what's even crazier is that in the wacky world we live in today, it's widely accepted as the norm, as if there were nothing wrong with it. Now, I don't think folks in my generation agree with that, but they're so shell-shocked from other financial disasters and other government blunders, they have virtually nothing to say about it. Just go back a dozen years or so. If I told you back then that our nation's leading technology companies would lose 3/4 of their value in a tech wreck, and that 10 years later they'd still be selling for half their peak value, you would have said, I'm crazy. But that's exactly what has happened here in the NASDAQ. Or go back just 3 years. If I told you back then that Merrill Lynch, the biggest brokerage firm in the world, Citigroup and Bank of America, two of the 3 biggest banks in the country, and AIG, one of the largest insurers, were all going to be on the doorstep of bankruptcy within just 12 months, you would have referred me to a shrink. And now here we go again. Supposedly conservative central banks all over the world, especially in the U.S., are running their printing presses to buy up mortgage bonds, corporate bonds, even stocks and real estate. As Mike Larson, Tony Sagami, and Brian Rich just told you, this is precisely what is happening. The Bank of Japan is doing it. The Federal Reserve just promised they're going to do it again. So that leaves the few of us who are still sane with only 2 choices. Either sulk in a corner or come out fighting. And our experts clearly favor the latter. In fact, the crazier the events, the bigger the profit opportunities, especially in countries and currencies that are more solid financially. In those countries, you have the demand from a new generation of consumers. Plus, on top of that, you also have a big liquidity push, that influx of funds from printing presses all over the world, especially in the United States. Now, will the dollar eventually recover from all these attempts to trash it? I think so. I hope so. But a lot of damage can be done in the interim. And if the Fed runs its money printing presses too fast for too long, the dollar collapse could spiral out of control. The good thing about global investing is that you're not stuck in just one country like you used to be. You have several strong ones to choose from. And the good thing about currency markets is that there's always a bull market in at least one. This is Martin Weiss for Money and Markets. I'll see you here again next week.